Hey, welcome to the exchange. Hey, Peloton earnings came out this week. I mean, I think data is absolutely incredible for some of the wrong reasons, though. Also, I'm gonna take a look at what the stock actually worth, in my opinion. So this is the third quarter FY22 shareholder letter. This is from Barry McCaffrey. He's the new CEO of Peloton. Comes over from Spotify, so he has Spotify background. So this is an interesting letter that he actually wrote. So basically thanking all the Peloton members for their hard work and all their success as a community, etc. But interesting note here. So Peloton's growth exploded during COVID when our subscribers grew from 700,000 to nearly 3 million. I mean, it's just been a massive up and up, both 2020 and 2021. But now it's starting to flatline quite a bit. We're going to see that a little bit later. Peloton is one of the country's most admired brands, ranking second behind Apple and ahead of Spotify. So again, there's a lot of brand value there, and it is a premium brand. I mean, whether stock is down or not, it doesn't matter. The brand actually is well known as a premium brand, semi-luxury. I mean, it's kind of on that edge where we might consider a luxury brand too, but. So it's interesting too. So this is from the CEO too. My goal for Peloton is to become a global connected fitness platform with 100 million members. I mean, so right now they're at 3 million, trying to go to 100 million. So it's talking like 33x right there. There's no timeline with this at all. But I mean, that's pretty farcical. I mean, who knows? It could change, but I mean, that's a way out there goal. There's no time commitment to say, hey, 100 million members by like 2028 or 2029, etc. So I mean, this is pretty far out there, but yeah, he's been in the role since February 9th looking at this, but really he has three main goals right now. Number one, by far, and I agree with him absolutely, stabilizing the cash flow. Number two, getting the right people in the right roles. So that probably means shifting and or probably downsizing the actual Peloton staff itself. And number three is growing again. I mean, in my opinion, 2022 is basically a wash. I mean, it's going to be pretty ugly overall. It's almost guaranteed at this point. 2023 is probably going to be a wash too. I mean, there could be some tail end where they, this time next year could be a little bit better. But I mean, the first half 2023, which starts in like July 1st, going to the December 31st, I mean, it's going to be pretty ugly continuing forward. So that's the last point I want to make. And he's launched a service called Fitness as a Service, FAST, trying to make a software as a service kind of parody basically there. What FAST is a rental program that combines a cost of connected fitness hardware with our all access subscription service in the one low monthly fee. So really the target here is a sub 100K kind of, basically monthly income or annual income user, trying to get that underpenetrated market. Because Peloton's right now, I mean, it's a pretty premium brand. I mean, you're talking like typically, it mostly leans to women, but also it typically leans 100K plus of actual annual income as a household. So I mean, this is kind of that really way to penetrate the lower ends of the market and trying to get basically Pelotons in every home if they can at all. But again, we don't know the pricing of this just yet, though. They're still tweaking it quite a bit. But again, we'll see if it's going to happen. I mean, this should help grow up top line revenue. But again, actual gross margins and everything else, we'll see if it's actually going to be profitable or not. So this is the same model of Peloton I've been using in my previous videos too, but really I color coded it here. So everything you see in red basically is a downtrend or it's bad news. Everything you see in green is good news. Starting off the top line, I'm saying total revenue of $3.5 billion. I mean, looking at here, subscription revenue, it's green. It's been up. I mean, they have actually a pretty steady growth rate. I think year over year is something like 50% or so. I mean, it's going to decline a little bit though, but I mean, it's been a pretty solid growth rate and it's pretty high margin too. So that's fantastic for Peloton. Now, the problem really right now for Peloton is the hardware side. This is the bikes and the treads. I mean, they're just not selling them. There's not enough inventory. They're moving fast enough to actually go out the door. I think inventory right now is at $1.4 billion. I mean, they basically have 7 months of supply basically in the warehouses right now, just sitting there that they can't sell off quickly enough. So that's been the big problem there. I mean, looking at overall year over year, so right now in 2021, I'm saying it's a little over $4 billion. 2022, which we're in right now, $3.5 billion. I mean, it's going to be less. We already know that. The question is how much less is it going to be? But I'm saying almost $500 million less versus 2021, which makes sense though too, given coming out of COVID and loss of demand and kind of like forward buying you had during COVID. Now, hey, everyone who has a Peloton now, or wants one, already has one now. So now we're kind of seeing almost like the hangover effect of the post-COVID era for Peloton. So gross margins wise, margins actually improved for the subscription side. I mean, they're at roughly 70 or 71%. Went up basically like 100 basis points there, basically a percent. Fitness products, actual tread and bike themselves, I mean, they're actually very negative right now. They're at, I think, negative 11%. I'm actually show you that real fast. So this is the actual connected fitness products gross margin. So third quarter FY21, it was 28.4% gross margin. Second quarter FY22. So this is from October through December timeframe, basically holiday shopping period, 6.4% positive. This last quarter from January to March, in 2022, negative 11.4%. So that means every bike they sell, they lose 11% of the actual direct cost, which is roughly, I mean, looking at here, it's a little over $100 of margin. Basically, you're just burning cash at that point. I mean, this is atrocious. The CEO did mention the earnings call that this is going to go back to positive probably in FY23. I mean, it might hopefully break even. I mean, if it doesn't, I mean, this company's going to be absolutely just dead. I mean, this is not sustainable for any kind of near term futures because there's the volume they're doing is so much. I mean, they can't burn cash that fast. They don't have enough cash in the bank to really maintain their actual the levels they have right now. But going back to the actual overall model itself, again, I'm saying operating margin as a whole is 25%. I mean, I think they're saying roughly 30%. I don't think it's that high. I mean, they're having some major headwinds. So I think I'm calling 25% pretty generous. Long term, up in the 30s potentially, but I mean, this is really a short term, almost like dip. But I mean, it's going to be very, very nasty if they can't shift the business around fast enough. So OpEx side, I mean, this is the almost the root of all, like the cause of all the problems. I mean, it is just atrocious. I mean, given the revenue base, looking up here, I'm saying $3.5 billion. OpEx spend, this is I think maybe the potential low side is $2.4 billion roughly. I mean, it's just a horrible, horrible ratio there. They also included in their OpEx expenses last quarter, basically some restructuring and impairment stuff right there. I mean, I stripped it out real fast. I mean, that's about 340 million. OpEx is dropping though, so FY23 should be a much better OpEx number. I put that down here. I'm saying 1.5 billion. I mean, the CEO is saying 1.8, 1.9, so I was pretty generous on that side, giving that back. I think it's going to drop a lot faster. I mean, I think layoffs are a very big possibility for Peloton because the OpEx expense has to come down. The revenue growth rate is just not going to be high enough to sustain kind of OpEx spending they have right now. I mean, they were predicting for 2022, 23, like growth to the moon, full saturation in the U.S. market, and then to go international, etc. I mean, really, the growth topped out way earlier than they expected, and also their OpEx spending hasn't dropped out quite a bit. But it has to drop down now. Otherwise, I mean, they're burning way too much cash for the basic revenue they're bringing in and the profit they're bringing in, which is, again, it's just not sustainable. It's going to come down. I know that. I'm going to show you this real fast. So this is actually their 10Q. But look at this number right here. So this is total revenue, 964.3 in the last 3 months of 2022, basically the last quarter they reported. Look at the total operating expenses, 920. It's 95% of the revenue is operating expenses. Phrased another way, for every dollar revenue they bring in, they basically spend 95 cents on OpEx revenues. And that does not include, cost of goods sold, supply chain, transportation, etc. I mean, it's just like, it is not sustainable. And that to me blew my mind how high it actually was. So overall net loss, I'm saying, a little, or roughly around $2 billion at least. I mean, it could be much, much more. I could be understating this quite a bit. Next year, this is including drastic OpEx cuts, probably some layoffs too, potentially, and hopefully, and they still maintain a small growth rate potentially if they can at all. I'm saying that next year they lose 500 million. Well, again, that might be well under too. But I mean, the CEO does know, hey, cash conversion or cash, consciousness basically has to be top of mind for every single department within Peloton right now. Otherwise, they're going to get absolutely killed, basically on the cash burn rate itself. Overall valuation here, I'm looking at roughly, looking at FY26 operating income. I put an EV to EBITDA multiple on it, which is, I'm saying roughly 12. That might be a little bit high. It might be a 9 or a 10 at most, potentially. I might be a little generous on that side. I'm saying stock comp dilution, roughly 2%. Shares outstanding, 378.83 million. I'm saying stock value, what it's worth right now today at $5.43. I mean, it showed considerable fight. I'm still shocked it's above $10 right now, given these numbers, because I don't know if people have seen these numbers yet, but these are just like, once you do the math itself, even the cash burn rate, unless they have massive growth in FY23, it's going to be very, very ugly next, 2-3 years at least for Peloton. Even long term, I'm like, if things don't flip around fast and soon, they don't get costs under control, they're going to be absolutely wiped out if they're not careful. So I do want to point this paragraph out to you. This is from their shareholder, basically the shareholder letter they sent out. So liquidity free cash flow, net cash provided by used in operating activities, less CapEx or capital expenditures, and internal use software development costs was negative 746.7 million. A higher outflow than anticipated. Primary drivers of our underperformance were higher inventory payments, softer than anticipated demand, both Peloton and Precor side, as well as higher detention and demurrage, shipping, logistics, and storage costs. So basically, shipping bikes from Asia to the US, etc., storing those bikes. They have $1.4 billion of inventory right now. It's a lot of inventory. You have to put it somewhere as a holding cost there no matter what. Like, you can't hold it for free, etc. So they ended Q3 with $879.3 million in cash and cash equivalents. They also have a $500 million revolving credit facility, basically a credit card in a way, for a corporate credit card. That's the way to think about that. Third quarter operating cash flow was negative $670.1 million. CapEx, internal use software development costs, were $76.6 million in Q3. the majority of which were related to construction of the Peloton Output Park in Troy Township, Ohio. So it's basically that holding facility, or basically their factory they built in Ohio, which they shut down. They still have the land, I think, later in second half of this year. But as you can see here, I mean, they're talking over 500,000 or 500 million, plus burn rate per quarter potentially. So you see these burn rates right here. I mean, these are massive numbers, and you see negative, how negative they get very fast. I mean, they're going to run out of cash probably by end of year if they don't raise cash, either debt or equity. Potentially by December at the earliest or the latest. I think earliest, I mean, it's going to be the summer time frame, just because they're going to get very, very tight very, very fast, especially if we go in a deeper recession right than we are right now. I mean, it's going to get very, very ugly for Peloton. That's why I see, hey, the stock value, if it also becomes a cash crunch, or basically a cash or credit crunch, I mean, they can get absolutely killed. And this could be a sub $2-3 stock if they're not careful. But again, we'll see. We're not quite there yet. So I do want to address one thing too. So there's the whole idea of a buyout. So whether it's Amazon or Apple, for example, and those are kind of the rumors floating around Reddit and all that stuff. I mean, really for Amazon, they have the Rivian deal right now, which is kind of falling apart. So I mean, it's actually killing their actual income statement, and they're having monthly or daily actual expenses from the Rivian write downs, etc. Now, as for Apple itself, I mean, they could acquire Peloton. They can absolutely afford it. It'd be no big deal. And the really problem with Apple is, what are they actually gaining of value? Is it actually worth potentially? And really, look at actual fitness trackers. Like, they have the Apple Watch, Apple Health, all that stuff too. I mean, they don't need Peloton. I mean, Peloton could absolutely love to have Apple, but really for Apple's case, basically all you're buying is a bunch of debt and a bunch of bad assets potentially. So long term for Apple, I don't see them acquiring it either. Hey, but that's Peloton. I mean, overall, I mean, just press F to pay respects. I don't really know what's going to happen with this one. I mean, I wouldn't be shocked if it goes sub 10. Even sub 5 wouldn't absolutely shock me. But I mean, this is definitely going to be an interesting one to watch next 12 months. But hey, be sure to sub, like, comment down below, and that's the exchange.